Let's get to our newsmaker of the morning, Ron Barron, the CEO, CIO, and portfolio manager for Barron Capital, who is out in the Hamptons right now. Ron, it's great to see you.
Hi, Bex. How are you?
Good.
Hi, Joe. Hi, Andrew.
Hey there. Ron.
Good to see you, Ron. I'm guessing that you are where a lot of people from Wall Street are these days, hanging out on vacation somewhere away. But I'm also guessing that you're watching the markets very closely, given what's been happening, all the volatility. What do you think of what we've seen over the last week or two, the moves in the bond markets, what that means for stocks?
Well, not watching as carefully as you would think I would, as most people do. Just a background for my business for a moment is that, so we managed $30 billion, and we had $100 million under management in 1992, and we made $28 billion in profit since then, and we've beaten the markets from inception for 98% of our funds, and we're in the top 6% for 61% of our funds. So basically, we have a very, very strong track record. And we're long-term investors, and what you read about now, or what you hear about now and listen to every day on the news are events that disturb most people, worry most people. So whether it's what's happening in Hong Kong, whether it's interest rates, whether it's the Fed, whether it's oil prices, whether it's Brexit, whether it's what's happening in Europe, what's happening in China, trade wars. So everyone is worried about these events. I thought one thing was sort of interesting to me in the last couple of days, that the president has announced that he had an interest in purchasing Greenland. And what that reminded me of is that we bought the Louisiana Purchase, which was 1/3 of the country, for $13 million in 1807. That works out to 3 cents an acre. And then we had something that Seward's Folly bought Alaska, I think it was 1860s, and that was something like $17 million. And so the president is a real estate guy. And so he understands real estate values, obviously, and maybe he has this in his mind. But one thing that was really interesting to me about this is that Greenland is owned by Denmark. And one of my really good friends was the ambassador to Denmark for George W. Bush in the 1980s. His name is Stuart Bernstein. And I used to tease him all the time about, I said, Stuart, congratulations on an amazing job you've done as ambassador. You've kept us out of war with Denmark. And so he would smile. But maybe we need Stuart to come back just in case things get a little rough. So my bottom line of it is that when you think about all the developments that are taking place and everyone is worried about them, it doesn't mean a lot in the long term. And what we think about is that the government. So one of the things that is amazing to me is that people are lending governments money with negative interest. $17 trillion is lent out, and people are going to get back less than they've paid, less than they've given. And when you think about that, the government, they're lending it to governments, and the governments have said, we are going to make your money worth less. So the governments are devaluing the currency against things, and you're giving them money that you're not going to get back for an extended period of time and not going to make any money on that, making less. And the reason that that's happening, I think, is incredible fear. And the reason you have so much fear is that 10 or 11 years ago, you've gone through this terrible financial crisis. And so people still remember. You've lost a generation of investors, just like you did after 73, 74, just like you did in the 1930s. So you lost a whole bunch of people that will never invest again. I was listening to Jeff Trout, us out this morning, and he said that his daddy told him that what is really interesting, he should never worry about good things happen to companies that are really cheap, that stocks that are really cheap. Now, my parents, they never were able to invest in stocks, but if they had, they wouldn't have known what a growth stock was or a value stock was, but they would have said, if my dad learned about it, would have said, well, good things happen to growth stocks. We invest in growth stocks for the long term, and don't worry about all these things that everyone, that you read about or you hear on television every day.
Ron, I appreciate
that's what's given us this good performance.
I appreciate your long-term view, but for investors who maybe don't have the same time frame as you, would you tell them that they would be foolish, or they were foolish, if they were selling last week in an 800-point decline for the Dow? Would you be telling them, stay the course, don't worry about everything that everyone's worried about all around you?
I would be telling them that, and in fact, so my family and I are now. I had a negative net worth in 1970, and we're now the largest investors in our mutual funds. And I invest so even after that's the case, I still invest every single month. And in the first week of August, when the market was acting erratic and when it had fallen sharply, I tripled the investment that I make every month in the funds that week. So basically, when I invest, month in, month out, every month, consistently, that's what advisors do. That's what advisors for individuals, financial advisors for individuals, they're getting paid for advising people how to manage their money, or manage money for them. And the average mutual fund probably makes 6 or 7% a year. The average investor in the funds makes 3 or 4%. The reason for that is they're always buying at the wrong time and selling at the wrong time. They buy high and sell low because they're emotional, because they read what is happening and they say, oh, my God, this is going to be terrible. I should have my money in cash. And so that's the way they react. And a good financial advisor or good, brokerage firms where they have their models, their job, and they earn their salt by getting people not to sell when it's a bad time to sell and not to buy when it's a bad time to sell, but trying to do things consistently. I've spoken before on your show about what a millennial should do. And millennials, I believe, somehow when they get to be 22 or 23 years old, if they get their parents or someone or somehow get their hands on $5,000 a year and invest $5,000 a year, what that's going to do for them, if all they do, they invest in a low-cost index fund. That's what they should do. Get a low-cost index fund, make 6, 7, 8% a year, and what happens at $5,000 a year, at the end of 10 years, it's $100,000. At the end of 20 years, it's $300,000 if you get historic rates of return. At the end of 30 years, that's 20 years. At the end of 30 years, it's $800,000. So you get to be almost a millionaire by investing $5,000 a year. That's what you have to do. You can't be afraid.
But let me ask, you said that's if we get historic rates of return. And that is one of the big questions that's circulating right now. People are wondering if we can possibly get those same rates of returns when you're looking at negative interest rates, when you're looking at $17 trillion in sovereign funds that are negative interest rates. Do you think we can still expect to get 5, 6, 7% a year historically, like we have gotten historically?
You're not going to get in fixed income, that's for sure. And what I believe is that when capital is very inexpensive, as it is right now, when you have this disruption that's taking place in Europe, in Japan, negative interest rates, you're not going to make money if you're getting negative interest, obviously. But I do think that, historically, that I think the growth is going to be faster going forward than it has been historically. That's number one. Faster. No one says that. And the reason for that is that you have technology that's making businesses more efficient and giving more opportunities. Knowledge for mankind is doubling faster than it ever has. Healthcare is getting better and better. Children born now, and 100 years from now, children born now will live to be 1/3 of them are going to be over 100 years old. The Facebook chairman is giving his money so that he will, cure the 600 diseases that present when you present to a hospital. There won't be them anymore. There'll be other diseases, I suppose. But the standard of living for the average person now, people talk about being left behind, but the standard of living for people right now is better than the wealthiest man in the United States or in the world 100 years ago. Mm-hmm. And that's going to get better and better and better. This is an amazing time to invest, an amazing time to be alive.
Having said that,
so I'm very optimistic.
You're very optimistic, but in the notes you did say that growth is a little slower right now. That doesn't concern you?
It's slow.
On the short, no, it's all. The growth in the economy ebbs and flows, and so if you have hotels and they're a little softer right now than they had been, they're up 2 or 3% same stores instead of 3 or 4%, or China is having some kind of a significant slowdown in growth because of trade wars and tariffs. Of course, you go up and down, and it's a wave. But long term, the value of your money, our biggest picture, not thinking about the events that you react to every day, the big picture that we have as a firm, is that the value of your money. So the government wants to borrow money from you, and you get and pay you back less than they're taking from you. But the big picture is that in addition to that, they're sworn to devalue your currency. They're sworn to make your money worth less and items were going to cost more. That is their goal. And so when that's the goal, you're lending someone money who's going to pay you back and has the ability to control how much that money's worth. So everything, we think that dollars fall in half in value every 17 years. So if you have $100,000 in the bank today, In 17 years, it'll be worth $50,000 in purchasing power. 17 more years, it'll be worth $25,000. 17 more years, it'll be worth $12,500. That's how come that when you buy the Louisiana Purchase, you buy it for $13 million. That's a third of the country. Or when you buy Alaska, you buy it for $17 million. That's a big deal. So what happens, we pay 3 cents an acre for Louisiana Purchase. That's not just because they've made a good investment. It's because governments, for thousands of years, democracies for thousands of years, the reason they stay in power is that they get people to invest and create jobs and build a strong, vibrant middle class. That's their goal. So the way they do it is they make sure that you, who have been very successful in our country, are forced to take your money instead of putting it in a mattress and invest it. That's what their goal is to do. Now you have a chance for your investments to grow more rapidly than you ever have before. Look at all the things that are happening in the world. I just was reading, to touch on Tesla for a second. We're an investor in SpaceX also. And they just sent a Tesla car around the sun, just past the sun. I was reading the paper the other day. Just went around the sun. That's pretty cool. So there's all these things that are happening in the world that are, that are providing growth. I mean, Elon Musk was talking about how they want to set off nuclear weapons and nuclear bombs in Mars to create an atmosphere. So, I was talking to Gwen Shotwell.
Can I just ask you? Go ahead.
So I was speaking with Gwen Shotwell about a couple of weeks ago, and she is the president and COO of SpaceX. And she said that, in her opinion, the only one who has a bigger vision than Elon for SpaceX is her. And she was talking about how she expects to get to other solar systems, other galaxies. That's where she thinks to perhaps meet whoever is there.
But Ron, sometimes you make these investments, and it may take a very long time to pay off. It may not pay off. In the case of Tesla, I think your cost basis is $218.74. That's just around where the stock is trading right now. This is one that you've been.
Is that exact, Bex, or is that the?
That's what.
Yes.
I'm not sure. My point is that your cost basis. Not to say that this won't eventually pay off and be a great investment for you, but to this point, it has not been. It's something that you're waiting for because maybe it's got a long lead time. How do you determine between the ones that are going to pay off and pay off quickly? How long do you have to stick around, and what do you think about the Tesla investment right now?
Well, with Tesla, there are many investments that we've made where it's been a very long incubation period that we have made, which is taken for the investment to prove out. When we invested in Vail between 1996 and 2006, we made a very modest return, 50, 60, 70% over 10 years, and then we made 7 or 8 times our money. When we invested in Wynn Resorts for 2001, we were one of the founding investors. And Steve Wynn invested $250 million, and a Japanese investor invested $250. And he told me that there will never be another investor in our company except for you, if you want to invest. And I'd like to have you as an investor. And so we invested after we studied the land that he owned and what he was planning to do. We invested $25 million. That was at $20 a share. And then when he ultimately went public, he couldn't get 12 people to sit in a room with him. And it went public at $15 or $16 a share or $13 a share. And we invested another $25 million. No, maybe we invested $50 million at 20, and then 20. And then when it came public at 13, invested $7 or $8 million shares. And ultimately, the stock went to 150. And so it was down after we invested. It was down 2 or 3 years later. And then people would say, I don't want to invest because it's not going to be a casino for 5 or 6 or 7 years. We invested during that period. We invest all the time when businesses are growing. When Tesla's case, Tesla, when we invested in 2014, the revenues were less than $3 billion a year, $2.7 billion. This year, the revenues are going to be about $27 billion. So the company has grown 10 times in revenues since the beginning. Then they were sort of struggling and producing cars. And next year, I think they're going to do $35 or $40 billion in revenues. And I think in 2 more years, they're going to do $100 billion in revenues.
Ron, in October, well, just to run through quick numbers, you just answer these for me. In October of 2018, Tesla was your 8th largest holding. Today, it's your 13th largest holding. That's not because you've sold shares, I take it. Is that because the company's shares are less valuable or because you've invested more in other companies?
That's because we haven't sold any stock, and that's because the shares in Tesla got us. So we talked about investing at $220 or $218. Mm-hmm. It went up to $380, and now it's back to $220, $225 with some self-inflicted wounds. And so we spoke about this, and I was saying that you invited me to come on when it was 380 and say take a victory lap, and I said it's way too early for a victory lap. There's no victory here, but I think that the opportunity here, there's 90 million cars a year that are sold, and our guy is now going to sell 350, 400,000 cars. Right now, you're able to expand in a time when no one else is expanding in the automobile industry. So they're able to build now in China with all the learnings that they've had in the United States. They're building for 70% less than it would cost for the same cars to build in the United States, and 30% less than it would have cost to build a year ago. And so what I think is that when we started looking at Tesla 10 years ago, 12 years ago, the cost of a battery for a car was $100,000. Mm-hmm. When they went public, it was like $30,000 or $35,000. They're now somewhere a little bit over $10,000 on the way to $5,000. Then you had 200 miles that you could get in a battery. Now you can get 370 miles. Pretty soon it's going to be, this year, I think it's going to be over 400 miles. So the quality of the car has improved. The distance has improved. The opportunity has not shrunk. And in fact, the reason they have this opportunity is all these car companies have hundreds of billions of dollars invested in plants that make motors. So their business is making motors. That's what they do. They make motors. So if your competitive advantage is you make motors better than anyone else in the world, and some guy comes along and says, hey, you know what? All that stuff, all those motors you make, we don't need them anymore. Are you going to drop all the motors that you're making and go make a battery where you're 5 or 10 years behind? So Tesla has an opportunity because other people are sort of slow walking. The guys in Germany are finding their leading industry in Germany. I think that 1 out of 10 people in Germany is employed in the automobile industry, 1 out of 7, something crazy like that. And they're saying, why aren't you guys making battery cars? The reason they're not is the unions are heavily involved in the management of those companies, and all those jobs that they have in making cars will be lost. All those investments that they have are stranded investments in making. Volkswagen's going to be a competitor, but the other guys are just going slow about this. Volkswagen is really making a big effort. Other guys aren't. Oh, one more thing, that now the law in the United States and elsewhere is that they understand that when you burn gasoline, I have other ideas to talk about too, by the way. Okay. When you burn gasoline, it doesn't help the environment. Right. And so they say, okay, there's countries all around the world that are banning the production of gasoline cars. In addition to that, they're saying if you're producing, in 5 or 10 years, in addition to that, if you produce these cars, you have to get a credit by saying that you're also producing a not polluting car. The cars that Tesla has don't pollute, obviously, because they're working batteries. Tesla is now selling $800 million a year of credits, probably $1 billion this year coming up, of credits for giving their fleet to Fiat. Just for matching for free. They're getting $1 billion. And so basically, a free cash flow positive, $5 billion in cash. Go ahead.
Ron, we're going to we want to continue this conversation with you. What we do want to do, though, is slip in a quick break because there's so much more to get to. And I know that you're in the middle of a thought on Tesla, and we want to get to those thoughts in a couple.